Hi everyone, it is Stephanie. I know it's been a minute since my last update, and I just wanted to give another update on some different tools and processes that I've started to bake into my stock investing analysis and sort of valuation process, and go through some of the and talk through some of these tools and processes with Alibaba, which is a company that I've been looking at a bit closer over the past week. And so, just to catch us up on where we last left off, though, I think the last set of videos that I did was more around using Professor Damodaran's valuation worksheets and techniques to, do these really in-depth DCFs and discounted cash flow models to come up with, some kind of final valuation at the end. I think in hindsight now, when I think back at this model, I realize it's extremely powerful, right? You have all these different parameters that you can tweak and kind of modify to really get as precise of an estimate as possible. But I also found that as I've currently been looking at the market on a broader sense and trying to get a sense really quickly of different companies, I figured that this model was a little bit too heavyweight for what I was looking for, given that at this point I'm kind of looking at a lot of different companies at a high level as opposed to trying to really go really deep into one. And so there's been a couple things that I've started to use recently that help me get a more quick and dirty read on what evaluation for a company might look like and how to think about whether a company is overvalued or not. And so this is where we left off. And then here I'll start talking through some of the tools that I've started looking at over the past few weeks. So the first is Fast Graphs. Fast Graphs is this really interesting tool that's built by a man named Chuck Carnival. He actually has a YouTube channel of his own. He does a lot of actually really great videos that help you walk through, right, how he actually uses the tool to evaluate specifically different companies, different sectors. And so there's a lot of really good content there that help you understand how to use the tool. So I've watched a decent amount of them at this point. And I, at this point, sort of use this as one of my initial screens when it comes to actually looking at companies. Because when I use the tool, it actually gives me a really quick read on how a company is doing, what the current valuation is, and then it gives me a really quick sense of whether it is over or undervalued, and gives me a sense of whether I should keep going and look further at this particular company. So for those that haven't seen it, I would definitely recommend that you check out his YouTube channel if you want to understand more. But at a high level, the way that you kind of interpret this graph is that the principle that this is built off of is this idea that for the most part, the price and the value of a stock is very much so tied to the rate of its earnings over time, right? And so in general, that's why the PE ratio can be so important. Of course, it's not infallible, but for the most part, it gives you a pretty good gauge and sense of whether a company can be over or undervalued. And so the way that you actually look at this is that there's two, so this black line that is jagged, right, that basically represents the ongoing PE and price to earnings ratio of a particular company. They give you basically month by month data on what that looks like in the past, so you kind of see what that trend looks like. And then outside of that, you also have these orange and these blue lines. So the orange line represents basically so it's a rough proxy, but it is a proxy for the rough intrinsic value of the company. And a lot of that is based off of the actual earnings growth rate of that company. So they actually have the calculation for how he gets that here. Basically, there's three different buckets. If it's a low growth company, he uses the Graham-Dodd formula to calculate what the PE ratio should be. For average growth companies, I believe he just uses 15. And then for high growth companies, so anything with a earnings growth rate of over 15, he uses the actual growth rate as the PE. So in this case, for Alibaba, since March of 2014, it's grown at a rate of around 37% a year. And so that is what you see here as the ongoing sort of PE for the orange line. And then outside of that, you also get another read on what a sort of baseline fair value multiple for this company might be. So it basically takes, for this entire time range, it averages out what the PE for this time range was, and it charts it on this as well. So This basically gives you two measures to measure the current PE against, right? It gives you a measure of what we think intrinsically this is worth given how fast this company is growing and how fast it's growing its profits. And then it also gives you a sense of for this company specifically, right? Because sometimes, there are, I guess, weird times where, the company's PE could be slightly off of the intrinsic value. So this gives you a sense of for this company, right? What historically has it traded at? And so what you typically want then is, of course, you want a margin of safety, right? So you want a company that has a current PE that is quite a ways away from either the intrinsic value or the normal the averaged out multiple for this particular company, because this means that if the price goes up, you have all of this sort of buffer, right, to be able to make a profit. And so this actually is a really fast way to, and so another thing you also, in this case, it's not kind of obvious. Like, for example, some companies like Amazon, where it's been around for a very long time, but its earnings growth has been, of course, like it's skyrocketed a lot more in the last couple of years. The numbers here get kind of wonky. So you can actually use this sort of top section to basically figure out how you want to zoom in and look at specific periods so that you can kind of normalize what the numbers look like. But in general, this helps you get a really quick sense, right, of whether a company is overvalued or not, because basically if it's under both lines, right, that is probably a good sign that it's somewhat undervalued. If it is, between one versus the other, it maybe gets a little bit dicier, and you could see that as, maybe an argument to be made that it's around fair value. But for example, if you see a chart where the price line is completely out of whack relative to what the historical rate has been, that's probably a sign that this is a company that's like quite overvalued, and is quite where I guess basically the expectations for the stock are not really matching reality and what the actual earnings growth for that company is. So yeah, this is a really helpful tool that I've been using lately to just help me do that initial screen, because I'll hear about, different sectors, different companies that are, considered cheap, right? And so usually I'll then jump into fast graphs to actually check out some of those companies, see what the chart looks like, and see if that's something that is worth investigating into further. So yeah, that's the main thing on fast graphs. This is kind of my initial screen. You have all these different metrics that you can also look at. So instead of looking at PE and earnings, you can look at the cash flow instead and see what that looks like. So for some of these companies, sometimes earnings is not like the best. Like for example, in the Amazon case, they say, let's just pull it up so we can look at it. So in some cases, some companies are better suited, like for example, maybe if you have a lot of CapEx, it could be more helpful to look at cash flow as opposed to earnings, because sometimes, so like in this case, like you could make an argument that, the current multiple for given the cash flows that are currently happening are actually somewhat reasonable, versus if you look at earnings, which of course is after depreciation, it might look a bit more unreasonable. So something else to consider. So yeah, that's I think all I want to say about fast graphs. Why are my stickies? Okay. So Alibaba, as I think we saw initially, it looks pretty good. It seems like, it's growing, of course, really, really fast. So, the lines are pretty aggressive. But, for the most part, it seems like historically it's hewed pretty closely to what closely to fair value. And then, of course, over the last couple of years, it's kind of started deviating further down from that. So anyway, and worth an interesting, looks pretty interesting, worth a closer look. So that's what we're going to go ahead and do. Okay, so that's the first item. The next item that I want to call out was, so we've talked a bit about Professor Damodaran's valuation approach, which is, perfectly valid, but, a little bit, intense. It can be a bit, it can be very specific and very granular. And so I have actually started using a slightly different valuation technique that I've sort of got inspiration from Cameron Stewart, who also has a YouTube channel. He's actually done a whole host of videos about basically kind of just walking through DCFs and doing valuations for companies, looking at, the 10K, looking at the materials, running through the models and kind of going through that. And so I have basically created, so he has like his own like Excel sheets that he works off of. I've basically created the same version of that, but in Google Sheets. And so this is what I've been using recently for some of the latest companies that I've started to look at. I'm not gonna go in this video. I'll talk through like the layout of the sheet so you have a sense of what how each section is sort of structured. But I'm not gonna go through the sort of all the processes and kind of how you calculate all the numbers because he actually does a pretty good job of that in his video. So as you can see, he actually talks through also some of the notes in the actual 10Ks themselves. So that is actually kind of helpful as well. And then yeah, I would encourage you to watch this just to understand what the process looks like. But I'm not going to go into it here since he already covers it. So at a high level, the way that he generally his process at a high level is he looks at the financial statements, he pulls that data from the income statement, looks at revenue, EBITDA, and some of these multiples, calculates enterprise value. He then also looks at cash flows, right, to see and calculate the free cash flow for equity, which takes into account the cash flow for operations, capex, and then debt repayment. And then basically once he figures out what the EBITDA for the company has been and looks at, the free cash flow per share, he actually does two different valuations. One that takes into account the EBITDA forecast and applies a multiple onto it and gets a market cap in the future. And then he also does the same thing for free cash. So he actually tries to estimate out what does free cash look like in the future, assuming a certain free cash flow yield for this company. He backs out another market cap and then basically weighs both of those to come up with some final answer. So that's basically what the layout of this looks like here. I have all the historical information up top. I have the forecast information and sort of looking into the future in the middle here. And then I basically bring them all together here with the calculation. And then he also calculates the IRR given the valuation, given the current price and given the valuation and the price that he's forecasted into the future to get a IRR back. In this specific case, because, and then he also has like 5 major like criteria that he's looking for when he looks at companies. So he's looking at strong revenue growth. So some degree of, I think he even just looks at positive revenue growth as long as it's not going down, and as long as it's not negative, that's good. He looks for earnings growth. He looks at free cash flow to make sure there is some free cash flow. He looks for a low debt ratio, so he measures that by looking at net debt over EBITDA. I believe the threshold he uses is like 3x, so that's his criteria. And then I forget how he words the multiple one, but there's like another criteria around the multiple. But yeah, in this case, because this is Alibaba, they're a Chinese company, they report their results in yuan. And so I actually have a section here where I actually, I basically pull out a certain exchange rate that I want to use. So you can update this if you want. But basically, in this case, I actually pulled out the original numbers from the actual, in this case, actually, that's a good point to talk about data. So in this case, I did not go through the 10Ks and actually pull out the numbers from the 10Ks myself. I'm using a service called Financial Modeling Prep to help me get some of this data. So there could be, I will just caveat this there is a potential that the data could be slightly off because, the way that they scrape the data, some things could get messed up in translation. So this is the data that I pulled from Financial Modeling Prep. It is in yen, and then I apply the exchange rate on it to get these numbers in dollars here. Another thing I'll call it when we're talking about data sources is I found that some of FMP's data around like EBITDA has been kind of wonky, which is kind of understandable given that EBITDA is like non-GAAP. So I think there are like different companies and there's all these different kinds of EBITDA. So I think it's a little bit tricky sometimes trying to get this number entirely accurate, because I've also seen when I cross compare against different sources, people report different numbers, so it gets kind of confusing. But I've noticed that their data for EBITDA and their data for debt repayment can be kind of off. So I actually look at stockanalysis.com. I actually pulled out their EBITDA and debt repayment numbers, which I've seen historically seem to be a little bit closer to what other people have said, and I have referenced that here. So definitely, if you want to double check and kind of verify some of these numbers against some other outside source, feel free to and update some of these, but that's sort of what I have. Okay, so what else can I tell you about this spreadsheet? So yeah, we talked about this at a high level. In general, like he does all these calculations he looks at EBITDA, he calculates an enterprise value, he looks at the multiple, so EV over EBITDA, which is quite similar to the PE ratio, right? So price PE ratio, meaning market cap over the amount of earnings, which is kind of synonymous to this case, which is enterprise value, which is kind of like market cap, but not quite, because you take into account some other pieces, like total debt and excess cash, over EBITDA, which is basically a sort of variation of earnings. So he looks at net debt. In this case, it looks really good because they basically have very little debt given how much cash that they have. And actually, these numbers look kind of weird. Total debt, net debt. Oh, anyway, yeah, there's probably some interim calculation. Anyway, generally looks pretty good. In this case, it's negative because for some of these, the excess cash is more than the actual total debt. But yeah, in general, the numbers look really, really strong, right? They've been growing revenue ridiculously fast over, the last 10 years. EBITDA has also been growing quite strong along with that. And then when we come down to operating cash flow, we're also seeing that also be pretty strong. CapEx is growing over time as they are investing more into new businesses. As you can see, it's kind of started to accelerate a little bit more, which makes sense given that they were previously only kind of working in. Oh, actually, I just realized I didn't go into. So for those that aren't familiar with Alibaba, here are some choice things I pulled out from the 10K that would be interesting. At a very high level, Alibaba has it's basically this like really major tech platform in China. They started out, they're kind of in some ways really synonymous to Amazon. So there's a lot of things that are in common, just like business wise. So similarly, they also started out as a e-commerce platform. They started out with Surface. I actually don't know what was the first one. They have a timeline in their annual report that talks about it, but they've got all these different platforms and services that, like for example, they started with Chinese consumers. So Tmall and Taobao are the two most popular surfaces for Chinese people to actually buy stuff online, sort of similar to what Amazon is sort of like here in the US. And they also have all these different wholesale sites. So they don't just sell to consumers, but they also sell to businesses. So they have different surfaces for within China, and they have Alibaba for international businesses as well. And then similarly, these are, I think, probably, not quite as big, but, AliExpress is a similar surface for international consumers. So like if you were international and you wanted to buy off of, the Alibaba platform, you would use AliExpress. Lazada is basically the similar platform, but for Southeast Asia. And they've got some of these other ones as well. So for the most part, they are a huge e-commerce juggernaut. That's where they make the bulk of their money. But of course, as they have, gotten bigger and they've started going into new industries and new sectors. So they have a whole like digital media entertainment section. So they've got Youku, which is one of the, I think like the top 3 video platform within China. They've got like a studio, so Alibaba Pictures. They've got some of these other surfaces. Outside of that, Elimi, I guess, yeah, that's how you pronounce it. But they basically are like a meal delivery service. They've got logistics and people that help with fulfillment. They've got like a whole advertising platform. They've got payments infrastructure, and they also have cloud. So they're also a cloud platform and provide cloud services and infrastructure for companies that want to build on top of that. So if you think about it, this actually mirrors a lot of what Amazon has been. So it's really interesting because if you look at the history in the annual report, I'll just pull it up really quickly. They actually have a timeline, and it's interesting to actually look at how this is kind of compared relative to Amazon, because I think they actually started around the same time, which is like the late 90s. And then as you can see over the last 20 years, you've seen them sort of add all these new sections and new sectors, and services. But in general, there's a lot of synonymous pieces to Amazon, right? So because you've got like the Amazon platform, you've got like FBA, you've got like Amazon video. There is what else? Like of course AWS versus Alibaba Cloud. So yeah, a lot of interesting parallels. And so anyway, yeah, just brief aside since I didn't talk about that at first. So in the 10K, I also pulled out some interesting numbers around just given, all the different areas and different businesses that they have. I pulled out this breakdown and table that gives you a breakdown of what percentage of revenue comes from each. So as you can see, their core commerce, right? So all of their e-commerce stuff is still the vast majority of where they get their money from. So it's still around just over 85%. And then you can see cloud is growing over time, but is still relatively small. And digital media is also pretty small. And their innovation initiatives is even smaller than that. So for the most part, this goes back to my original point, which is like you can see CapEx going up over time. That makes sense because as they have been, getting into all these new spaces, some of them are a lot more CapEx heavy, right? So like logistics, of course, because you're dealing with like physical infrastructure. When they're extending out their actual like data centers and cloud platforms, that of course is going to be hugely expensive just to build out, the buildings and outfit them and get that all up and running. So we've seen CapEx go up over time, so that makes sense. But still, they of course have the cash flow to cover that. They have been, so debt repayment, so positive basically means that you issued debt. So the cash is coming into your company, and negative means that you're starting to repay debt. So that's cash flows going out. So, they've had a decent amount of debt coming in the past, and they are starting to pay that back now. So in the end, you get free cash flow to equity. And then we're able to, once you take into account the number of shares, we get a free cash flow per share. And from that, we can also calculate the yield once we know what the price looks like. So now that we have a sense of, what EBITDA looks like over time, we have a sense of what free cash flow looks like. This is so that's a historical view. Now you want to sort of look ahead and figure out, and try and forecast out, how does revenue change over time? How does EBITDA change over time? And from there also, how does free cash flow change over time? So the estimates that I'm using for my calculation is based off of what I saw in a Morningstar report, actually. So let me pull that up. Let's see, I think I saw deep down in here. Usually, I guess typically you would try and read through some of the investor presentations to understand like if the company is giving guidance around what they think revenue and profits are going to look like X, number of years into the future. I tried looking at their investor site and I didn't see anything super promising. So I ended up I initially did one sort of extrapolation just looking at EBITDA, but then I saw some interesting numbers from Morningstar that I ended up using. Let me see if I can find it. It is, okay, here. So yeah, we assume a revenue CAGR of 22% for the next 5 years, including 40% for growth. I didn't end up using that, but you can if you want. And they also say, okay, EBITDA margins. So they also see EBITDA margins remaining in high 20s over the next few years, versus in the past it's been around like 30, slightly over 30. So high 20s over the next few years, but then they expect the margin trends to inflect over the medium term as investments wind down, they spend less CapEx, their nascent businesses scale, so they expect the 2030 adjusted EBITDA margin to be back in the mid 30s. So that's basically what I went with when I calculated this. And so yeah, I basically did 20s for the next 5 years, so like mid 20s, and then I brought that down over time because of course as they get bigger, that growth is going to be harder. So I brought it down to 12%, but this is where, so I'm going to make this sheet available. So you can feel free to copy this and kind of tweak with the numbers as you want. But this is where you can kind of figure out like how aggressive you want to be. Maybe you are very optimistic and you think it will be, I don't know, closer to like 18 or something, closer to 20. And so all the numbers should change. Okay, wait, let me just confirm. Yeah, okay. So yeah, all the numbers will change depending on how you want to be aggressive with some of this. So in this case, I think I just put this as a flat 25, and then I basically figured out how, or I basically did a formula to given this end rate, like it helps, it provides these like interim rates to come down to this particular level. So you can update this if you want to be really negative and you say, maybe I think it's going to be like 8% for whatever reason, you'll get a number for that too. So anyway, and like if you want to copy the 39% they said for 2021, you can do that as well, which will make a lot of these numbers quite bigger. So anyway, I'm going to stick with 22. I'll stick with, what's my original 12? I think it was original 12. Okay, so I'll stick with 12. So that helps you forecast, okay, how is my revenue going to change over time? And then from there, you also will look at margins and what that will change, how that will look over time. And so in this case, I'm pretty sure they said high 20s for a while, but we expect that closer to 2030, we'll be back in mid 30s. So that's basically what I did here. I think I just did like on the lower side of high 20s, and then over time, then brought that back up to 32. So yeah, once again, of course, you can update this however you want, see how the numbers change given that. But that basically gives you, so we get forecasted revenues, we multiply the margin to get forecasted EBITDA, and then this is what the EBITDA change looks like over time. And then what you basically then do, just to kind of finish this out, what you do with these forecasts then is you take the EBITDA forecast, and I've basically copied that over here. And then from here, you basically use this EBITDA forecast and this forecast for what it will be in 2030 to come up with a market cap, because the way you do that is you have this EBITDA forecast, you have this multiple, right? We talked about how we were calculating this like sort of PE-like multiple called EV over EBITDA. And so you can choose whatever, you can choose a multiple that you want. You can use just the average one, which in this case looks like it's 24. You can update. Maybe you think that's like too much, or you want to be a bit less aggressive. And so maybe you'll say 20, maybe you'll say 18 or something. And so that we'll use this EV over EBITDA multiple. You multiply against EBIT, right? So EBIT times EV over EBITDA gives you EV, which is enterprise value. That's what this number is. And then as we talked about here, right, enterprise value equals to market cap minus total debt plus excess cash. We can, of course, reverse that because we want to get market cap and we have enterprise value. So what we want to do is we add debt to enterprise value and we subtract out excess cash. Did I get this wrong again? Minus debt. Oh, God. Anyway, is this correct? Minus debt plus cash. I feel like I just tweaked this and I thought this was right. And now this looks slightly off. Is it right? Market cap plus debt minus excess cash. Yeah. So that is the formula. So yeah, okay, this is correct. So we subtract out debt, we add back cash. In this case, some of this stuff is kind of arbitrary. Like you can kind of choose for yourself how much you want to put here. I don't think there's like any hard and fast rule against it. For debt, I just did one times EBIT because it doesn't seem like they right now use a lot of debt. So I just did 1 times EBIT, which is that. And then cash, I wasn't quite sure how much to put. Like I think, let's see. So excess cash I have as 15. I don't know what a good level is. Maybe I'll just like throw in, I don't know, 50. This is very unscientific. Yeah, I'll just do 50, which is like, what's it? Like 3 times what it currently is. Anyway, you can update this. Whatever you think is reasonable, you can update that. And so that will give me a market cap, right? This will give me a you will, you'll take out debt, you'll add back cash, you get the market cap in return. And then you'll divide that out against the number of shares. This I also tweaked a little bit. So you can use, you could theoretically just use what the current number of shares is and just use that to apply here. Especially if it's a company that has where the share count hasn't really moved much, or if it's only slightly gone up or slightly gone down, maybe you'll just use that just to make it easy. But in this case, I averaged out the amount. So as you can see, it's gone up quite a little bit, like every single year. It's gone up basically like 300 shares over the past 5 years. So it is, I guess, averaged out to a rate of around 2.4% growth. So I basically just kind of extrapolated that out for another 5 years. And I said, okay, I think assuming that they're going to continue to be growing a lot, I imagine they're going to be continuing to issue shares. So I gave it a couple, is it 6? 6 years, I guess. I basically multiplied out times 2.4%, which gives me a final number of just over 3,000 number of shares. So that's what I'm using here. And then you divide the market cap by the number of shares, which gives you the price per share. And so this is one view. So using the I don't know what the name of this is actually officially called, like some earnings multiple method valuation. I don't know. Using this particular method of using an EBITDA multiple and looking at EBITDA earnings, this is the price that we get for and for what we think Alibaba will be worth in 10 years. So, and then we're going to do another method. And so you'll want to figure out how you want to weight both of these methods. For now, I'm just doing flat 50-50. You could update this. So like if you feel, for whatever reason, like for example, free cash seems a little bit iffy, you can weight the EBITDA version a bit heavier, and this will update automatically. So let's just stick with 50 for now. And then let's finish this out and look at the free cash flow side. So to get the free cash flow estimate over time, I basically, in this case, I think there's different ways of doing this. Ideally, if EBITDA, the rate of change of EBITDA and operating cash flow is around the same. So let's say that they were both around like 66%. The method that I just did is probably a bit more reasonable. Where basically what I did is you took what the free cash flow looked like for 2020. You look at how this is growing over time, and you just multiply this number out using these growth rates over time. That's basically what I did here because I was lazy. But if you wanted another, in this case, if it's slightly off where in this case, right, this is like basically 11% higher than this. Another thing you could do is look actually at, so then this is something Cameron's done before, but you basically look at what the ratio is between EBITDA and free cash flow. And like, for example, if free cash flow is consistently like 3x EBITDA, what you could do is just look at these numbers and you multiply it with that multiple to get this free cash flow number. So lots of different ways you can do it. I'm just gonna be lazy. I'm just gonna look at these numbers and extrapolate that out. So I, as you can see, I basically, where to go? So yeah, I brought these over from here. I multiplied this times this to give me, wait, that looks slightly, why does that look off? Yeah, so I brought this over here. I multiplied this number out, so I get the free cash flow estimates and forecasts for the future. And then I divide that by the number of shares right here to get this free cash flow per share number. Let me go ahead and hide this again. And so what that gives me is it gives me a forecasted set of free cash flow per share numbers. And what I can do here, it's kind of like a DCF, but not quite because you're not really discounting anything. But basically you look at all the free cash flows going forward into the future. You come up with, you estimate some kind of free cash flow yield. You can take what the average has been over time if it's been kind of consistent. Or you can, override that and maybe say maybe I think, the price will be better. So maybe the yield will be better. Or you can just use the average by default. But you can update that here. It will, if you override it, it'll use it. If not, it'll just use the average. And what it does is you then, so free cash flow over yield is basically the price, the price over the free cash flow. So if you multiply price over free cash flow times the free cash flow, those both negate each other out, so you get the price. So if we multiply both of these together, so this times this, it gives you an estimated price in the future given the free cash flow also in 2030. So in this case, assuming a 4% yield, that price 10 years into the future would be just over $1,300. So as you can see, we get two pretty different numbers, which, you might want to gut check a little bit. But I think I think this is where this sometimes, you think you might want to sanity check it. But you can also decide how you want to weigh it. So maybe if you think some of the numbers look a little bit too aggressive, you can weight it slightly differently. So what I do is this green number then is the weighted number. Given the weights, given the price, this is what I'm getting. So it averages out somewhere in the middle, somewhere around just over $1,000. I also call out, given this price, what would that mean the market cap would look like given the number of shares? So with the current estimates that I have, this basically would assume that Alibaba in 10 years is going to be worth $3.1 trillion, which I guess you can use as a sanity check, right? To figure out, okay, do I think that's plausible? We've got, even today, right, a couple of companies like Apple, it's $2 trillion. You've got a bunch that are, some that are 1 point something, like Amazon, and then some that, right now, Alibaba is it's $611 billion of market cap. And so you can kind of gut check this to yourself to see if that seems reasonable. I also call this out here. It's basically 5x what the current number is. And so, you can sanity check this for yourself to figure out, does this seem sane to me? Does this seem plausible? There's, of course, you can look at, the bear and bull cases and kind of decide for yourself if you think that makes sense. And the last thing that I have set up here in this spreadsheet is calculating the IRR given the price that we've come up with. So basically the way that we do this here is that it takes into account what you're currently in for. We're just going to clear this for now. It takes into account what you're currently in for. So as of today, the price of Alibaba is $232, I guess. Let me just confirm because that was what I saw. So $232, that's the current price for today. And so given your current, why is this? Oh, looking at the wrong sheet. Given the current price of today, and given that let's say assume that you sell your stock in 2030 when this is this price, it takes into account how that free cash flow changes over time, and it nets out how much what your net sort of gain is. And so from that, you can actually calculate what the IRR for this particular investment is. And so with the current numbers that we have, of course, all these numbers are contingent off of these assumptions that I've made. And depending on the assumptions around the growth of the company, the margins, assumptions around the multiple and the yield, given those assumptions, the IRR that I get is around 24%, which is quite good, as I've seen in my very limited experience. And I've also calculated the cash on cash return, which is basically given how much I am in for and how much cash I put in at the upfront, here's what the return looks like in 10 years. And so this is helpful just so that you kind of have a way of being able to measure the performance of each different potential investment that you make. So you can kind of weigh that on a sort of equal basis. And then lastly, one helpful thing that would be helpful is to actually, so of course, we're doing this at this moment in time right now where the price is $232. Of course, prices fluctuate, right? They go up, they go down. And we also have this distribution that gives you a sense of, so I've actually mapped out for every 10, 20, and 33% up and down from the current price, how the IRR changes, if it goes down 10%, if it goes up 20%. So you can kind of wait for yourself how that will change given the price, given where you think it's going to go in the future. I actually, so the way, if you're gonna set this manually yourself, the way I've set it up so that you can kind of like, because basically, as all these numbers change, right, this number will change, which means as you change all this, as this changes, if you want to look at this, you'll need to recalculate what that IRR looks like for that price. So, like, for example, if I, let's say I like change my multiple and I say it's 20, my final price has gone from like 10.23 to like 10.65. So I go up to like 25% IRR. And so you'll want to re-update these numbers to take into account like what that looks like. So the way I built this in, so like say right now, right, this is now 25%, it's not 19%. So what you could do, so let's say we just like wipe all these out. What you can do then is say, okay, right now this is 25, 256 is 23, and then so on and so forth. So that's basically how you could re-update it for yourself. I personally, on my own personal worksheet, have created a I've created a script that actually helps me auto-calculate these so that I don't have to manually do it myself. So here, I'll just show you quickly what it looks like. It's very cool. I'm very impressed with it. Okay, let's say I just change this to 18 like we did earlier. So my number has changed. And then if I calculate it, will it run? Let's see. Oh, and yeah, so basically what it does is it does that whole process for you automatically that I just talked through, so that I don't have to calculate it myself. So yeah, that I think in general, that's the tool. Of course, if you've got questions, feel free. You can definitely, I guess, comment on this particular video. But yeah, I would definitely recommend, if you haven't seen Cameron's videos, watch through this, especially if you want to understand the process a little bit better, because he does a pretty good job of talking through that. But yeah, that is the tool. I guess I will probably just include some of my notes that I've made. Feel free to delete them if you want. But yeah, I have some notes that I've just made about the company. Okay, what else is there? So, okay, we talked about Google Sheets. We talked about data sources. So yeah, once again, caveat that like you might want to check some of these numbers yourself, because the numbers that I'm using aren't necessarily always probably 100% correct. Oh, okay, fast graphs. Going back to this for a second, one thing I wanted to call out was that all the stuff that we just did right here, right, where we're kind of punching in these numbers, we're putting in these multiples, we get this price back, we've calculated the IRR. Actually, a lot of this you could actually shortcut and just do from within fast graphs if you're super lazy and you don't want to deal with this, because he's got this forecasting tab where it basically does the same thing for you automatically. So the way that this works is that you've got so he's got different tabs that do different things, but so in this particular example, in this tab, right, it keeps the growth rate of earnings fixed, so that's synonymous to like basically this, right? So assuming, an X% increase in earnings, in this case, 35%, 8%, and 24%, this is driven by, some kind of consensus percentage from these 40 analysts that cover Alibaba. Given this growth rate, with they've got all these different variations of multiples, right? You can go, like right now, it's hovering around 23. But let's say you think it might go up, maybe it comes down. You can actually, what you can do is you click this, and let's say I think I'm going to hold on to this at least for like 2 years and, keep it medium term. I can say, okay, maybe I'm not very aggressive and I don't think, the multiple is going to change very much. I can click that. You click the endpoint and it actually does all that work that we just did for you. So what we did is we assumed given the growth rates that those analysts said, given a multiple that you chose, what is the price? It gives you an estimated price of $307. And it also from there gives you what is the rate of return, right? So in some way that's kind of similar to IRR. What is the rate of return over the 2 years that you held it? In this case, it would be around 16-ish%. So yeah, this is actually a super powerful tool. I mean, of course, you can kind of do it for like different durations, right? So you can do it maybe only for 1 year. You can maybe assume like maybe you think the world's going to crash and the multiple is going to go to shit, and see what that looks like. And so all these different tabs are kind of variations of this, right? So this assumes that the earnings growth is going to be what the analysts say. You might want to take this into account sometimes, because if you look at the analyst scorecard section, they've got the summary piece that gives you a record of how accurate these analysts have been in the past, looking 1 year into the future, 2 years into the future. So of course, if it's like generally hit, if it's hit or beat, like that's a pretty good sign. If you see miss, that's a warning that you maybe want to take some of these estimates and maybe like give it a second look. Alternatively, this tab is kind of the same. It just, I think, tweaks the multiples that are shown here so that it's closer to what the normal PE for the company looks like. And then these last, I think, 3 tabs are more about if you change the percent growth, or if you if you have different options for the percent growth of the company, like you can then, vary that to come up with the same number. So this looks at, I believe, the last, as it says on the thing, 3 to 5 years of growth. So in this case, I guess it averaged out to be around 27%. So given 27% growth for the next, 5 years, you can then do a similar like calculation. Historical CAGR, I think this looks at 5 year. Oh yeah. So you can choose like what time horizon you want. So like maybe the last 7 years, which is gonna be really aggressive, or you can look at the last maybe like 2 years where it's been a little bit slower. So yeah, this you can kind of tweak what you want the earnings growth to be, and look at that. In the last tab, you can actually just punch in a growth rate entirely yourself. So maybe you can be like really pessimistic and say, I think it's all going to tank. You can kind of map out what that would look like as well and do a similar exercise. So super helpful tool. I use this sometimes, I guess. And this would be especially if you don't want to deal with some of this, this could be a really great way to, just really quickly get a quick and dirty sense of what some of the stuff looks like. Fast graphs is I'm just using the basic tier, which is I think like $16 a month. I'm pretty skint with the way I spend my money, but I found actually it's actually kind of interesting because I looked at this tool initially and I thought it was something I could easily replicate myself. So I was like, I can calculate this, I can calculate that, and create this graph. But as I've looked a bit more into it, I think it actually, with the forecasting tool, with like the analyst scorecard and stuff like that, it is actually presenting, it has been pretty useful for me just to be able to sanity check some of these things really quickly. So yeah, just FYI if that's something that you're interested in. That's fast graphs. I'm gonna talk through Morningstar. I think what else is there? So typically, I guess my process, just to go back, is I'll look at fast graphs. I'll look at this graph really quickly. Get a sense of whether I want to dig deeper or not. I'll, usually then read through the 10K, try to get a sense of the company, build out this spreadsheet, type in some of these numbers, figure out what I want to use for some of these estimates. I'll come up with, my sense of what I think it looks like. And come up with this IRR. And then lastly, I think especially because I'm still a bit of a noob right now, I like to sanity check what I get with what other people get. And so this is where I've typically after I kind of finish, I'll kind of poke around and get a sense of different equity research reports for some of these companies just to see what they're saying about a company. And so Morningstar I actually get through my library. So if you might want to check out to see if you have access, because I think at least at my library, they're pretty generous and they've got all these different investor resources that you can look at. So it's actually is pretty good data, and like some of the analysis is pretty solid. So what to call it here. Yeah, so it was helpful for me to just read through some of the analysis here. What is helpful about their report also is that they kind of give a fair value for what they think the company is worth. I'm guessing that is not looking forward to the future, but like right now, what they think the fair value is. And they also give you a sense of like how to think about price. So that's pretty helpful. I also really like this feature that gives you a side-by-side comparison of all the different companies it competes with and how they all compare against the overvalued, undervalued, et cetera, et cetera. And they also actually really helpfully give you a sense of like, okay, what are reasons to like it and reasons to not like it. So yeah, I was looking through Morningstar, and then I also found this other report off of S&P Net Advantage that in some ways is quite, I don't know if there's like a lot of super original stuff. I did think their analysts research comments. So basically the idea with Alibaba, the sort of the read on Alibaba right now is that and so actually let me just pull up my high level notes that I prepared. So basically at a high level, I think there are lots of reasons to really like Alibaba, right? It is a dominant player in a very fast growing sector, right? E-commerce in a very fast growing country. So China, of course, is kind of like on the brink of base. I guess it's still considered emerging, but is very much so getting to a point where they're growing quite fast. And what also helps in Alibaba's favor is that e-commerce is a really big share of their retail sales, sort of unlike a bunch of other, maybe in some ways more developed countries, and also in some developed and developing countries. They have a pretty fragment. So in the US, right, like there is a pretty strong physical retail presence. You've got all these malls, you've got strip malls, you've got department stores, and we do a lot of shopping. Like we just have built out a lot of infrastructure to do a lot of shopping in person, and e-commerce is something that's kind of come on after the fact. But because China's been developing more recently, right, in a more modern era where we've had things like smartphones and the internet and stuff like that, they have a much more fragmented physical retail landscape. And as such, a lot more people actually just do things on mobile, do things online. So that portends really well for Alibaba because, right, that means that they are already a really established player in a space that is really dominant in a country where, you're expected to see a really high degree of multiples for GDP and income growing into the future. So I think I saw this random metric online where the per capita GDP is estimated to go from just under 3,000 to around 25,000. And so, of course, you have to do some translation to figure out how that translates into disposable income and percent that is spent. But in general, like, of course, you see that this is going to go up quite a bit over the next even 5 years. So yeah, Alibaba is really well positioned. They've got two of these like really big brands, in addition to all the new ones that they're starting, that are sort of front and center when people think about e-commerce in China. Just to sort of illustrate that a little bit, I think just looking at B2C alone, Tmall is, I think the stat is a couple years old from 2018, but it had a very, like, if you look at just the market share, 61% for Tmall, and then JD, which is another e-commerce player, has around 25%. So really, I think that's a really good place to be, especially if you're investing in this company. And another thing that's also really convincing is just the fact, like, just how deeply penetrated they are into the company, right? I think they said in their report that they've got 780 million consumers, people who use different products of theirs within China alone, and that is over. Did I write it down? I don't know. I believe I saw a stat. Yeah, I saw a stat somewhere that they were saying just Chinese internet users alone is just under like a billion people. And so if you think about it, it's like around 85% penetration, which is insane. Another thing to think about with regards to Alibaba is that they've got, in some ways, kind of like Amazon-like structure, just corporate structure, where they've got these like cash flowing businesses, right? In Amazon's case, and also in Alibaba's case, they've got these like very profitable marketplaces that are just churning out money, and they've got a model that really works. And they are using a lot of that cash flow to sort of nurture these new nascent businesses, right? So things like, if we go back to this sheet down here, things like Alibaba Cloud, things like their logistics business, things like, these new like e-commerce platforms that they're trying to spin up, Youku and video and all these sort of like side sort of businesses and projects that they have. So yeah, like they're very much so. So I think to some degree there is this open question, right, of like how are these things going to scale? Will they actually take off? So there is a bit of unknown there, but in general, they're in a really good position to be doing some of that work now. And if it pays off, we'll sort of see how that goes, the next coming years. Some, of course, though, with such strong and such great reasons to buy, of course, you might be wondering like why. So, why is it so low, and what does this look like? And why do we sort of see this trading at such a low multiple relative to what it's been before? And so one thing I think that has sort of weighed, I don't know actually when this started, but one thing that's definitely weighed on Alibaba and a lot of these Chinese stocks more recently is just the fact that there's been a lot more scrutiny when it comes to the government. There is, I guess some people would say, a pretty high risk of more regulation of different laws that are going to be put in place that will affect profitability. You're seeing it especially centered around Ant Financial, which is the payments group that Alibaba owns 33% of. Yeah, so basically here, and so that Ant Financial specifically was supposed to IPO last year. They got forced to put a pause in that as they're being forced to kind of take into account all these new regulations. So that's a big uncertainty. I think there is, given that so one thing I will call out, I don't think I mentioned this, is that like the way Cameron did in his video, all this does not take into account the 33% that Alibaba owns an Ant, so this is entirely independent. But I mean, obviously, the value of Alibaba probably does take into account some degree of their Ant ownership, and of course, that will probably be impacted with all the stuff that's happening around Ant. So, it is unclear how some of that will shake out, but if you're okay with that risk and you think it might not be that bad, it's something that it's definitely something you'll just want to weigh as you make this decision. So in summary, I think for me, I personally feel pretty optimistic about Alibaba, especially because for me, I'm thinking about investing for the long term. And so I think I see, a lot of these sort of attractive points about the company. I see the numbers, I see the growth. And to me, it looks pretty attractive. But of course, I will say if you're investing more in the short term, like let's say a year or under, I think Alibaba is probably a much cagier bet. Like I'm not quite sure, I think there are probably other stocks that would make more sense, that would give you a more immediate return, because if you actually just look at the charts for Alibaba, okay, as you can see, so this is looking at the last year, basically. As you can see, right, ever since October of last year, it's kind of been on this downward trend, right, if you look at the trend channel. And so in general, it is not a super great, I mean, it definitely seems like it's hitting some degree of support right now. But in general, I think, it's not a super great sign if you're investing in the short term. So, something to take into account there. Okay. Anyway, that is all I think I want to say about that. So I looked at the summary. Okay, yeah, so at a high level, just to recap, my general process is look at fast graphs, read through the 10K, do the valuation worksheet, and then sanity check that against some of these equity reports. Okay, we're in the final stretch. I think that's basically it. Two last things I just want to call out really quickly. One thing that I personally wrestled with when I was starting to do this worksheet for the first time was around this IRR number. So I think one thing that's kind of especially if you're relatively new to this like I am, I think sometimes it's hard when you don't have much stuff to compare it to. You don't have a baseline. You don't have a sense of, you haven't looked at many of these. It's hard to get a sense of, is 23% good? Is it bad? Is it okay? Like, how should I think about this? I imagine over time, like you start to get a sense of like, okay, like those were really good and that's maybe not so good. But another thing I've realized, and I think that could be a helpful guide for thinking about this and thinking about goals when it comes to money, is you can use this CAGR calculator. So I actually just had this epiphany maybe like a week or so ago about how to think about basically almost setting goals for some of my like investment activities. So let's just like play out a theoretical example. Let's say that I have, I don't know, like $5,000 right now, and I want to, let's say I want to buy a house one day and I need money for a down payment. I need money for mortgages. So let's say I need like, I don't know, $50,000. So, okay, I need to 10x my money. Let's say I'm fairly young. Let's say I'm going to give myself like 10 years to do that. And so what you can actually do when using this calorie calculator is it actually helps you calculate if you have this particular starting point, if you want to end up here and you have this much time to do it, this tells you actually how much growth you need to get every single year to actually achieve that. And it actually maps out, of course, for you. Like, I'm starting out with $5,000. Here's how much my pot of money needs to grow every single year to get me to, $50,000 by year 10. So this is where I think this actually can help act as a a barometer for you, kind of to get a sense of, okay, depending on what my financial goal is, right? Let's say I want to double my money. Let's say I want to earn enough to pay off my student loans or whatever. This can help give you a sense of what IRR, basically what growth rate you need to aim for in order to actually make these goals achievable. So of course, in some cases, 25% I think is actually relatively high, especially to sustain that for so long. I think is going to be even tougher. Especially, I think with some of the commentary that's been made recently around the fact that because the stock market is so overvalued, this next decade, I think there's a lot of people saying there's a potential that this could be a lost decade where things are just not going to grow very much. Because, things are already so overvalued right now. So I think 25% is actually kind of high. But this is where you can kind of toy around the numbers to get a sense of, okay, you can either figure out whether you need more time to achieve this goal, or maybe you need to be less aggressive in the way you set some of your goals. But basically helps provide you with a baseline for how to think about this IRR number. So just thought I would throw that in there. Actually, I kind of want to talk about this really quick. I did not have this planned, but one thing that I pulled from the Professor John Madarin's, I think one of his videos is he has a lot of historical data around how different sectors have done over the last, many decades, in almost the last 100 years. And so one thing that's kind of interesting to note here is that in some ways, for a lot of us who are kind of starting out to invest and, you're still relatively early on in your investing career, I think in some ways the market that we've been in has kind of been unnaturally unnaturally successful almost. As you can see, right, return for the decade for stocks over the last 10 years, just from 2010 until now, has been 250%. Of course, over the past, however many decades, that is somewhere kind of in the middle. You've had better decades, in the 90s and the 80s, where it's closer to 400%. But on the other hand, we've had decades in the early 2000s where actually it hasn't moved very much at all, right? So, of course, in the 2000s, we went through two different recessions, right? Both in the early part of the decade and then later on with the great financial crisis in 2008. But I think this is where, I don't know, just I guess a bit of history, because I think one thing that I feel I definitely take for granted for sometimes is just the fact that, the stock market, it will always go up, right? And I think over the long run, you're probably right, because for the most part, it does tend to mostly go up than not. And, there has been two different decades where it has gone down, but I think, just something to sort of think about as you're kind of thinking about some of this stuff. I don't know. Okay, that was kind of random. I think, the last thing I just want to call out was, so I have this worksheet that I've created for Alibaba. I actually personally have also been looking at AbbVie recently, and also Bristol Myers, both of which are pharmaceutical companies. So I'm just going to include these for free in this spreadsheet when I share it, just because I already made it, so you can feel free to look at it. But these are I would just note, these are slightly different, in that the way that I've calculated some of the forecast numbers is slightly different. So in Alibaba's case, I looked at revenue and then I took out a margin from that. In this case for AbbVie, I think I just kind of copied Cameron. I think he just basically did a EBITDA growth over time, and just kind of estimated out what that would be, and then kind of just carry that over to free cash flow. So that was pretty simple. And then for Bristol Myers case, I think this was a little bit different and this is just, this is, I believe, taken from the way that they talked about their future forecast in an investor presentation where they talked about how the growth was going to change over time, but it was non-risk adjusted. So he cut off some of that value for risk, just taking into account, especially because pharma companies are extremely, very boom and bust, depending on what the science looks like. And then they also had a bunch of notes around operating margin. So that's what I put here. So yeah, that is, I think, everything I wanted to cover today. That was just over an hour. Yeah, I hope this is helpful for anyone who is thinking of dabbling into some of this. And yeah, I hope this is helpful. Have a good one. Bye.